Alright, this is our sector overview. I'll be doing consumer discretionary, and I'm Ray Kruger.
And I'm Nicole, and I will be doing consumer staples.
So I'll start with consumer discretionary. So in one of our readings, this is how it's defined. So companies that derive a majority of revenue from the sale of consumer-related products or services for which demand tends to exhibit a relatively high degree of economic sensitivity. And then looking at the S&P 500 in our portfolio, we're pretty much bang on with what we hold. So here's a 5-year performance. So 2013 would be at the very end, about 2016 in the middle, and now consumer discretionary is the blue, S&P 500 is the yellow, the red is just kind of a 50-day holding that the website put in there. So since about, I guess, halfway through this graph, consumer discretionary has been outperforming the S&P 500, not by a lot, but better than what it was in the past. So there's a ton of industries, and honestly they're all pretty self-explanatory. Hotels, restaurants, auto components, automobiles, all this kind of stuff. As long as you read them, you'll pretty much understand what's going on in each of the industries. So in our portfolio, we got 4 companies. 2 of them are auto components, hotel resorts and leisure for Wynn Resorts, and specialty retail for Dollar Tree. I'll break down auto components and Wynn Resorts for orders and everything else. So starting with auto components, new entries pretty low. Companies are specialized and have dominant names and patents. So for Goodyear, their 2 main competitors are Michelin and Bridgestone, and those 3 companies pretty much control everything in that one industry. For Copper Standard, they're a bit different because they have a bunch of different parts, but for the majority it's 2 or 3 companies in each part that they produce is going to be their major competitors. Buyers is pretty low. People are always going to need tires on their cars and brakes. So suppliers, it's kind of medium because looking at their 10Ks, cost of materials can be easy to access sometimes, but they're also international, and with a bunch of new tariffs and all this stuff going on with trade and what to do, it was a risk for them. Substitute is medium because it's hard to find innovation for stuff like this. For tires, I guess really like treads and stuff like that is going to be innovation or how they use them. But once you do, I know Goodyear has that as a risk because they want to be the first for innovation. They don't want Michelin or Bridgestone to beat them to it, and then therefore have like a dominant product. And then existing rivalry at medium as well because they're dominant names, but there's also low action of barriers, and there's really only 2 or 3 companies, like you said. So just break down Copper Standard quickly. Supplier of systems and components for automotive industries. Products include rubber and plastic sealing, fuel and brake lines. They opened up to a price of $117, and our target price for them is $108, so they're better than what we have target price for. This is kind of a graph since when we bought them, 2014, so they're slowly been increasing. Existing rivalry, like I said earlier, is going to be their major force. There's 3 or more companies in each thing that they produce, so they have a lot of competition going on. And risk factor, pricing pressure, and losing large consumers. So Ford, GM, and FAC are their big companies that they have. So if they were to lose one of those to another competitor, that would be big time. And international risk, like I said. So that's going to be things like labor regulations, currency exchange, all that kind of stuff. Some headlines, they're up 0.5% since their last report, so not huge, but better than going down. And then their major competition are those companies. Now looking at Goodyear, it's kind of been going up and down since we bought them in 2014, as you can see, and then kind of been on the decline as of late. We have a target price for 38, and they opened up today at 23, so obviously well below what we target them at. They develop and manufacture markets and distribute tires for most applications. They also market rubber-related chemicals for various applications. Their biggest force is threat of substitution. If they don't keep up on innovation and the competition gets upper hand, then that can easily put them down out over Michelin and Bridgestone. Recently they named a new CFO who was with the company, in 2002, and he was a VP and treasurer. And they're very cyclical, these last two companies. Next industry is wind resorts, so hotel resorts and leisure. Buyers have a lot of power in this because money comes with their consumers. There's so many options, especially for wind. One of their biggest resorts is in Vegas, and there's a lot of hotels in Vegas and casinos, which is also something they have for buyers to choose from. Suppliers is pretty low. They have materials that they can build all their stuff on, so that is pretty low. Existing rivalry, very high, because now even with new trends like Airbnbs and stuff like that, people are somewhat shadowing away from hotels. And even casinos, there's a lot more casinos, and there's just a lot of options when it comes to those. So entrance is pretty low because it's hard to open up a new high-end resort, I would say, in Vegas when there's so many already. Consumers have so many options to pick from. And substitute is high because product variety is very high. So you can have restaurants, you can have a very high-end restaurant, low-end restaurant, Airbnb, a hotel, just ranges. So this is Wynn. Our target price for them is $146, and they're at $125, so obviously on the decline from what we have them at. Existing rivalry would be their highest porters force, because hotels and resorts have so many options in the biggest market in Vegas. Very cyclical. When people have money, they're going to gamble, they're going to go on vacations, and that's so their new headlines. There's a typhoon in their second biggest place in China, and Wynn Resorts, there's 2 casinos, and they were actually the first casino to open up in that area. I'm not saying that a lot of people want to spend money after a typhoon, but they were open. And then a big news is they have a lawsuit against them right now, as fellow company is suing them for rigging the Boston license. They got a gambling license in Everest, and the company is suing them, saying that they rigged that to get it. So that's kind of ongoing right now. It's around $2 million in the license they're suing for. And the major comps are MGM and Marriott.
So, go back for 1 second. Yeah, that mouse is a little sticky. So what has happened in 2018 that has caused their stock price to slide so much?
I would say the lawsuit against them obviously was a big part of it, and that's really all I can find for like new things happening to them. I know also their owner, he also has, I guess, some private things going on. So their 10K, he got sued, I think, I want to say sexual something in the workplace, so that obviously is going to affect them pretty well too. I think he also
that
stepped down.
That was 2018 or 2017, Steve Wynn stuff. What about some of the growth markets? Where could Wynn really conceivably grow? They're opening this casino in Boston. Is that really a growth market for casinos?
Not really, I guess. But for them, I guess it's such a big deal they got the license because it's been wanted by so many different people, so it's a big deal that they got it. And then looking at them, they only really have like casinos and hotels in the China area in Vegas, really. So I guess they could expand a lot more to many different places. They're not really globally dominant, I guess.
So Macau is kind of the Vegas of China, and there have been some issues there just because a few years ago there was a crackdown on government corruption, and a lot of money laundering happens through those casinos. So then all the casinos that had large presence in China were hit pretty hard. So it's something where that kind of over-reliance on one market might be challenging for Wynn going forward.
I also seen in that one that China is cracking down from where people can travel from the mainland to there, so that's also taking away from some of the people who are visiting there. Casino there. And then finally, our last one, Dollar Tree. Pretty self-explanatory. It's a dollar store. Everything we buy every day, every occasion for $1. I had them as non-cyclical because it's a dollar store, so it's kind of not, the people have money or don't have money, it's not gonna be a big thing, but for them, they list it as when holidays are coming up, is kind of their prime time for when they make most of their sales. Existing rivalry I have, because Target, Walmart, all these places offer similar items, and people go to Walmart, then they can pick up a couple things they need at the dollar store. They're not just gonna make a special trip to the dollar store. They have a lot of risk factors with international stuff as well. And then if you look, our target price at today's price, pretty much dead on, so they haven't really declined or anything for us, they just kind of stayed the same.
So consumer staples are pretty self-explanatory. So the companies in this sector are primarily involved in the development and production of consumer products, which covers food, alcohol, tobacco, household products, and your personal products, which would fall under household and food and all of that. And these component stocks include Procter & Gamble, Philip Morris International, Coca-Cola, and Pepsi. I got that from the Spider website. That was their definition of this sector. And it is 6.74% of the weighted holdings for S&P 500, so it's a pretty low percent. And this is the 5-year performance compared to the S&P 500. We were pretty close to following it, and then it declined a little bit. And that's it for that. And then the industries within this sector are food and staples retailing, food, beverage, tobacco, household and personal products, and then these are all held in a SIP portfolio because we have Kroger, we have Walmart, CVS, and Costco. And I would say it's counter-cyclical because this sector performs better than the economy when the economy is not performing well, since these are staples such as groceries. I mean, everybody needs to eat, so. And then there's a couple other large companies that you might not think of being as large companies, but I put Amazon and Target because both of these places do sell food where, Amazon, I can't remember the specific name for it, but they do deliver groceries in the lower 48, not here, but in the lower 48, and then Target also, most of them now carry food. You know, they have the milk, bread, everything like that. And then for the industry breakdown for the Porter's 5 Forces, I did the food and staples retailing and the household and personal products. So the threat of entry is pretty low because there's already so many established food places such as, Walmart, Fred Meyer, which is Kroger. And it wouldn't be smart to enter this business because they're on such a large scale that, look at all the mom and pop shops. Most of them aren't doing so well because of all the other big businesses. And the capital requirements are very high to get the space, the products, and even to produce all of that. The power of suppliers is medium because most stores use or produce their own brand. So like if you go to Fred Meyer, their store brand is Kroger. If you go to Safeway, it's Signature Select, I think, for most of it. So they do have options compared to just selling the name brand of cereal or whatever brand they're selling. And the name brands, I feel like, especially here, they're pretty limited when it comes to supply. And then the power of buyers is medium. Buyers have the option to switch to any other, retailer for food or staples. There's Amazon, there's Target, there's Fred Meyer, there's Costco. So there's different places, whether it be online or a brick and mortar store. But there's not a threat of consumers credibly, I wouldn't just go start a store just because. So that's why I put medium. And then the threat of substitutes is high. There's so many competitors consumers can switch to get their food and staples. And I kind of related it back to this, that you can get your food even online. And then rivalry among existing firms is high since there are so many options for consumers. They all sell almost everything that you need for staples. So Amazon, for example, you can get Clorox wipes, or you can also order milk, in the lower 48 and get your food delivered. And then common risk factors for food and staples retailing and household and personal products. I put shortage in supply or contamination. We all saw within the last, it's probably been 8 months now, it keeps coming back up, the E. coli within the produce. So that is a big thing. If you go to the store, you'll see that there's no salad. So hopefully you don't like salad. And then transportation. I put this as a risk factor, especially here, because when transportation is halted, and I don't know if you guys remember, it was within the last year as well, there were the barns that got halted on the way to Alaska, so there was no meat in the stores or in most of the stores. And then I also put a risk factor is store loyalty, so when a consumer only shops at one store, you know, like Fred Meyer, they have the reward points. People will shop there even if they're paying a little bit more because they have that brand loyalty. And then they didn't have, I didn't think it was special for metrics they use, but they do use growth and gross profit margin to, let's see, yeah, they measure it by success of consumer staples and long-term growth and gross profit margin. So they pretty much are just using their revenue to say how well they're doing, which I don't think is very special, but that's how they gauge this market. And then emerging trends, which I've already talked about, is food delivery or pre-order food and pickup. So Quick List that Fred Meyer does, that's an emerging trend. More stores are starting to do that. Costco also is starting to deliver. It's called Instacart. And then Walmart also has a grocery delivery as well. And CVS, I found out, has pharmacy delivery. I did not know they deliver your medicine, which is nice. And then I kind of broke this down with their target prices and what they do. So Kroger, they sell food, they manufacture facilities. They have multi-department stores as well, so not only do they have your groceries, they also have clothes. Walmart is kind of the same. And then CVS is just a retail and healthcare company, and then Costco is a little bit different since it's a membership-only warehouse, but they sell the same products. And the target prices, they all kind of vary. Kroger is the lowest at $28, and then Costco is the highest at $178. Let's see. And I didn't put what they're currently at, but I think that they're around what our target price is for most of them.
So when you look at our portfolio, do we want to see stocks trading around our target price? What's that target price represent? And this isn't just for the two of you guys presenting, but maybe someone in the class wants to take that one.
So what you think they're valued at?
Yeah, what you think their value should be.
Yeah.
Right? So if the target price is less than what they're currently trading at, what does that tell you?
Probably not the best investment.
It might be time to sell, or it might be time to look at them again and see if our target price is correct, because we look to update these target prices for every stock probably about once a year.
Yeah, and you want them to grow too, so if there's not going to be any growth, you might want to change a couple around where we have some growing and some that are stable to diversify.
Yeah, we've had instances in the past, like for example, pitching Costco, which wasn't exactly a growth stock, but it's a healthy income stock.
Oh, this is growth stock.
But
Extra 2,000 stores a year.
But so you can definitely look at things that you're not necessarily looking for huge capital appreciation, but at the same time, I'm only pointing that out because I've heard a few people kind of have confused references to what a target price should represent. Like, do we want a stock that's trading near its target price or not? When there's big discrepancies, like a really big gap between the current trading price and a target price, that's usually an instance where we want to at least look at the stock a little closer to see what's causing that, whether it's in either direction, whether it's trading well above or well below its target price.
And then just some news about a couple of these companies that I found last week. So Kroger, their outlook is a little bit cloudy from what I found. They did grow, but competitors such as Walmart and Target had bigger growth, so they don't really know how they will follow that growth. And then Walmart is bidding on a blockchain, and essentially what that is, from what I found, is they're going to be making the supply chain more traceable and digital by tracking things better. And then CVS is merging with Aetna, which I think could be really good for them, since Aetna is an insurance company. You know, insurance and medicine kind of go together typically. And then Costco, the news that I found on them is their earnings are solid, and their growth has driven strong prices up within the last week. That's what I found last week. So I don't know what it is today, but.
A couple things you might think about, because you guys have a lot of brick and mortar retailers, especially in the Staples side. There are a few special metrics that retailers tend to look at, things like same-store sales growth and sales per square foot are usually big. Let's see, there are also on the other side of the house, there are some specialized metrics with like with hotels especially in terms of occupancy rates. Obviously that's only one of our holdings in that side of the house, so I wouldn't be too concerned with that unless you're pitching another stock in that sector or looking at Wynn a little more closely. A couple other things. So how much of our portfolio is consumer staples? What % of the SIP portfolio?
$6.7. 9.2.
Oh, yeah. So it looks like we're, the discretionary is 9.9 and then the consumer staple is 9.2, so we have a little bit more than what the S&P 500 is.
Okay, and just given where we are in the business cycle right now and everything, is it a healthy thing to be overweight in consumer staples? Should we be concerned?
I think it's okay to be overweight right now because we are approaching the holidays, and I feel like that's typically a busier time for all of them. Staples doesn't depend so much on that, but discretionary does. You know, people are getting more money around the holidays.
Okay, and then I'll make one general comment on like quarters, five forces, the threat of substitutes versus existing rivalry. This is like a pet peeve of mine. So existing rivals and substitutes are two different things. So I oftentimes hear people say, well, there's a lot of rivalry in the industry, so the threat of substitutes is high. And that's not how it works. Like, for example, for a grocery store, a substitute would be maybe ordering your groceries online from like a non-traditional grocer, because it's not a direct competitor. Like Kroger versus Safeway, or Fred Meyer versus Safeway, those are rivals. Where like Instacart versus Fred Meyer, that will be a substitute. Okay? Okay. Okay, do I have a volunteer for our last group? We'll probably only get one more group done today, I'm guessing.
A little bit better that way.
Oh, good call.